Happy Friday, Pat. Welcome. Rick Helps Real Estate Show. We kindly call this the Mick Report because of why? McHone and McMasters. Let me put that up there for you.
Happy 2024. Wow.
Yes, here we go. Everybody's been
2024. I can vividly remember the Y2K 2000.
oh,
That was it's hard to believe that was 24 years ago.
I
24
was
years ago.
I was in the bread business and we had meetings with all the buyers at the grocery stores. And telling them, look, we think that everybody that goes in the store is going to buy one more loaf of bread than they normally do. And we're here to tell you that our bakery is not going to be able to keep up with it. So get with your private label suppliers, that for here was, Wholesome's, and tell them to give you as much bread as you possibly can because we're going to run out. We're going to give you every loaf of bread we can. And they Fry's didn't tell their supplier to increase it at all. Hello, Stephanie. And the buyer for Bashes, he was embarrassed. He goes, I didn't even order extra water. And the grocery stores were completely wiped out. It was almost like COVID. It went in, nothing but wire on the shelves. And they're calling me and they're yelling at me. We called and asked you for more bread and you said no. I said, well, because we don't have it. I'm so glad I'm out of that business. Gosh, anyway, so here I am in real estate having fun. So I wanted to talk about there's all this optimism going into January, and there's a lot of, I think, misinformation on what the central bank said, and it just starts growing on social media. I'll give you one example. Central bank says they're going to cut rates 6 times next year. They didn't say that.
No.
They didn't. There might have been a couple references on a dot plot, but they didn't say it. And to see agents spout it off on Facebook, it's just misinformation. Marry the house, date the rate. We told you this was going to come. We told you that rates are going down. Well, they're kind of backing up a little bit right now. And I know you're going to share those numbers with us, but this is the 7-day moving average again, Pat, with the blue line being new listings and the dark one down here being new contracts. So they're going to lag a little bit because you're getting new listings yesterday and today, and there just aren't any contracts yet. We'll have to see how the weekend shakes out, but this is typical. We're just going to have this dip down the holidays and get back. And what remains to be seen is, are we going to get back to what I call our pre-holiday level up here? This goes back several weeks. This chart goes all the way back to last year. You can see Thanksgiving, Christmas there. So this is summertime. So it's nothing fancy, but it's what I like to follow. And so I want to see just how back to prior holidays we go if we're going to exceed it, because there's a lot of chatter that says, it's going to get really, we're going to get a lot more listings out there, and here we go. Well, we always do in January.
Mm-hmm.
But at this point, we're not there yet. In fact, we look at the Cromford Market Index, there's a lot more green here. They've improved in January, and I won't read the whole thing here except that Michael Orr said the very mild optimism that was the order of the day in December is starting to look well justified. We recommend wild to moderate optimism for the month of January, at least as far as market balance is concerned. Transaction volumes remain subdued, but are more likely to recover if the market balance stays favorable to sellers. And here's our active listing counts now. So you can see we're not even back up to where we were in November yet. So we'll see if we're going to end up here or just flat. We always climb in January. So I'm just kind of tepid about saying that, we're going to exceed last year. Now here's expired listings, and they spiked up to 6,600, where last year they were at 5,700. Last year, actually, that was last year, 2022. We only went up to 57. And remember, last year was when everybody panicked and put their homes on the market to see if they could get that price. And when they didn't, they let the listing expire, and it just spiked. I mean, it was a huge, huge number of 6,000.
Yeah,
that's yearly count. But I thought that was interesting to watch.
Seems like about a month ago.
Yeah. And here's pending foreclosures. So that's the pink number down here. That's that's a big nothing burger for those that are waiting for foreclosures to hit the market. But what say you on rates, Mister Pat?
Well, job numbers came out today, 216 versus estimates of 170,000. I mean, but bottom line is keep it short and simple. I mean, the market reacted negatively. It was down like 30 basis points in the beginning, but then I think the market readers read into the report and said, this market job report was not as strong as it can be. Quite interestingly enough, the job revisions have been negative. The revisions the month, like a month or 2 months later, like 11 out of 12 months, they've had negative revisions of like 50 to 60,000. There was like a 70,000 revision this month. So, I mean, you could definitely see there's weakness below the surface. And believe it or not, I think the government jobs, Barry was saying, I think I saw a number like out of those 216,000, 54,000 were government jobs.
Jeez.
So I mean, I just, there's a lot behind the numbers. Matter of fact, let me if I can pull up this email that I got. Actually, this is a Fox Business News I had on in the living room here. I'm working from home today, but you see here, here's some snapshots off the TV screen. Charles Payne, the Payne report. He does a great job. Look at this. These red lines are the negative job revisions they did them, after. So there's 71,000 fewer jobs created than first reported in October and November. And then he reported also, he said October revised by 45,000 to 105. And then he went on to say, talking about how 676,000 people left the labor force, 683,000 fewer people employed. So a lot of these jobs were temporary jobs. People are getting, second and third jobs, and that's what's obviously causing. I think, once again, I think it's a result of the pandemic still kind of cooking through the system.
Yeah,
And
December doesn't count for anything anyway because it's just looking at real estate, everything just falls off.
yeah,
Unemployment goes down because people get holiday jobs, and then we sit in January and wait to see how it's all going
yeah.
to shake out. But
Well, you see, I mean, we've had a great run since, like I said, October 19th, 20th. We've seen rates, um, you know, staircase climb all the way down. And obviously, we saw a bottom here. We've seen, the market react. Rates have kind of bounced back up a little bit, but they're still under. Right now, this is a 20-day moving average. The blue line right here is a 200-day moving average. It's right on it. So, I really believe that the market, just looking at it from my perspective, the market got ahead of itself. It's over at, with all the talk about how many rate cuts there's going to be, 3 to 6. I mean, I think the market, it always has a tendency to go one way or another real strong in the beginning, then it moderates. And I think it got over it, they got over their skis, as they always say. And I just, you know, my question is, what happens if the Feds don't cut as soon as everyone expects? You
yeah,
know,
because the bond market is looking ahead, right? So they're saying, well, we've got a cut coming, so they're pricing it in now.
yeah,
And if we get, let's just say that they decide they're going to cut in March, and they cut in March, we probably won't see rates move, right? Because
yeah,
it's
because it's
already
probably built
baked
into the
in.
market. It's typically built in the market, a month or two
But what
beforehand.
happens if they don't cut?
Yeah, I know that. Well, see, that's the thing is, people got on this train the last 3 to 4 weeks, like, oh my God, how many realtors, mortgage people say, oh, we're going to see 3 to 4, 5, 6 rate cuts. Get ready, people. And, I just believe just the way the Fed has been playing the game. Obviously, it's going to be tough with the election year. And I think they are going to kind of play into that a little bit. It just seems they want to keep the economy moving along. But, if they don't cut, um, if they do cut, they can't put the toothpaste back in the tube, and they're gonna be in a really big quandary, or in a corner if they do cut, and then all of a sudden things are. I think they're going to stay higher for longer, a little bit. That's my take on it.
Well, here's the deal. As a real estate agent, I'm trained to help you get through the all the regulation for a transaction.
Yeah.
And none of us have. I shouldn't say none. Some have economic degrees, but
Yeah.
even those with economic degrees, they don't know what's going to happen. So, look, real estate agents don't have inside information on the bond market and interest rates. So, just
Nobody does.
I caution people when you hear these things, because I saw one this week that just drove me nuts. Marry the house, date the rate. Here we go. We told you this was coming. There's going to be 6 cuts. I got, whoa, slow down, slow down.
Yeah.
They said that they anticipate there might be 3, and it's trying to get people to hurry up and get out there, because what's going to happen. Rates are going to be really low.
Yep.
Everybody's going to go out and buy. And you know look, the central bank doesn't only just look at real estate, they look at everything. So they don't want they're probably baffled by how well the economy is doing in some measurements right now. They were expecting the GDP to be lower, and it's not. But it's, I think, in this, I'm going to show you this chart again. I looked at it a while back, and again, I'm I'm just this dummy in Arizona here, but I'm looking at the spending, right? And so you get here in 2020, our spending was up around $10 trillion, just went crazy, right? And then
Hmm.
2021, we have 7% inflation. Okay, so then it went back down, then it went back up in 2021 to 11 trillion. And lo and behold, inflation came in a year later at 6.5. Well, we dipped way down here to a little over $8 trillion in Q1, Q2 of 2022, and we ended up at 3.2% a year later. Well, is anything going to happen now that we went back up to 10 trillion in Q3? Will we be able to hold this 3.2 and go lower? Because I know that there are some projections out there that say, with the consumer price index coming out next week, that December is expected to be estimated 0.2. Prior it was 0.1. And they're saying we're going to be at 3.0. And prior to that, we were 3.1. But what about Q3? A year out after a $10 trillion in spending.
Hmm. I think inflation's still there. There's no doubt about it. One thing that kind of concerns me, kind of this headline the last couple of weeks is this Red Sea, all the turmoil in the Red Sea, the shipping. I mean, I'm hearing some crazy, you know, cost, estimations as far as shipping costs. So,
Yeah, it's funny you mentioned that, because I pulled this up yesterday. This is Google Earth, and this is the Red Sea, right? Right here.
mhm,
Okay. So the oil, and all, not just oil, but now they got to go all the way down here and around to get to us.
mhm,
This, what a mess that is. And this is a normal big shipping lane for oil here, but this is these companies saying they're not going in there. They're kind of
yeah,
tired of getting, the insurance companies saying, we're not going to insure you if you go into the Red Sea.
yeah.
That could add to costs.
Well, it will
Might be.
add to cost. So, I mean, obviously, that could be a short-term blip that the feds are probably keeping an eye on too. Because I mean, obviously, the supply constraints aren't as bad as they were in the pandemic, but still, I think it's bottom line is it's going to have some effect on it. You can't, you're not going to be able to avoid it. I
Yeah.
mean,
Yeah.
obviously, they probably do a pretty good job with AI, trying to estimate, shipping and it's a lag, but it's a lag effect because this stuff doesn't show up for 2 or 3 or 4 weeks. So it's gonna be interesting to see what happens there. So I don't think that's certainly not helping any type of inflation, um, story.
No, I think it's not going to go nuts like it did last time. Now our active listings, Pat, are still just kind of flat. We don't have it yet for January. This is right at the end of the month, but this is where we are. So the past 4 years, listings have not gone up in January. Um, but here's the confusion behind the numbers. New listings have. So the past few years, sales have kind of gobbled up the new listings as they came on. So we didn't have the number of available homes grow. So, we may have, like right now, if I'm sitting there looking and we have, what is it, 2,300 new listings come on. It's in the ticker down below here. New listings, 2,300. That was rolling about 3,400. And then we have new contracts at 1,800. That was about 2,400. So those are the numbers that if the new contracts fall below the new listings at below a 60% rate, total listings available will grow and prices will actually come down. But we still have a 97% success rate. So homes are selling. I've got a condo in North Central Phoenix right now, up on Camelback, and I got 3 calls on it today. So the buyers are out there.
Mm-hmm.
2 from California, and it's just a 2-bedroom condo. The other thing I saw that I brought up the other day, Pat, was canceled listings. Check this out. Only 19. Now, canceled listings are people going, I give up. It's different than expired. It could be a life event. We're going to take it off the market for a while. So the people that had their homes on the market decided leave them there. Not going to cancel them this year. So now you had a video there, did you?
Yeah. I'll pull it up here. Just talking about this is kind of interesting going into the job, job related to all the jobs. I'm going to pull this up here. Okay.
Port, and because of this exodus, the participation rate fell sharply from 62.8 to 62.5%. Now, here's how you come up with the unemployment rate. And I want to show you this because we can calculate where the unemployment rate really should have went without these people no longer being counted. So you have your unemployed was reported at 6.268 million. And then you have your labor force, 167.5 million or so. If you take the unemployed divided by the labor force, this is where you get your unemployment rate remaining at 3.7% if you round it. But let's add back the 676,000 people that they didn't count. Well, those people have to be added back into the numerator and the denominator, meaning those people are still unemployed and they should still be counted in the labor force. If you add them back, get this, the unemployment rate would not have remained at 3.7%. It would have went up to 4.1%. So I think this report is much, much, much weaker, especially when you consider that, hey, out of these 683,000 job losses, if you look a little bit deeper, we lost 1.531 million full-time jobs. And where did all the gain come from? 762,000 part-time jobs. This does not sound like a strong labor market for this month here. In fact, it looks like a very weak one when you break down where these jobs came from. And multiple job holders, people that needed to pick up extra work to make ends meet, they increased by 222,000 to a new all-time high of multiple job holders. So I think the market will die.
That's it.
Well, it's interesting because one of the things that the Chairman Powell did say and that they projected was that total unemployment at the end of this year will be 4.1%. That doesn't sound like a recession to me.
No. I think they said, I saw a report that said have to get to 7% before it really got down the number down to 2%, inflation rate. So to go from 3.8, 3.9 to 7%, I don't know. I do know I do see the job losses I'm seeing too. The real job losses are the ones that are, the engineering type. That's what always scares me is when you see the engineering like Salesforce or say IBM or Microsoft, they're laying off 10 or 15,000 people. Those are the job losses that always scare me.
Yeah, or if Intel decides to start laying people off. Well, we know it's coming. So we know we're going to have some job losses. I mean, that's the only way that they have to tame inflation. But, they also have to support the bond. I saw a video this week that said the Fed's job is on two sides of the coin, one unemployment and the other side, the bond market. So there's that dance back and forth. And we sit in our little real estate world and go, they're killing us. Well, they got bigger fish to fry than me selling a house. So I think I'm not expecting in January and February a rush of buyers to show up, and it'll start showing up next week if it's going to happen at all.
Mm-hmm.
Just at my 7-day moving average.
Things have picked up a little. I'm hearing, I'm anecdotally, I'm hearing, things picking up a little bit. People, lenders are saying their activity's picking up a little bit here and there. But obviously,
It's
with
picking
rates, I
up, but
mean,
it's not a mad rush that
no,
some people have been saying.
yeah. I mean, right now, if you go back to my chart, right now rates are moderating. I mean, rates were in the high sevens. Now we're looking at, high sixes. This is, $475,000 purchase, 5% down, 780 credit score. This is one of the lenders I'm going to. I'm just looking at one of my, lenders that are listed here. You're looking at about, 6.875 is a little cost. High sixes, FHA is going to be lower than that, low to mid sixes. So, I mean, rates have moderated, but it's not something that's it's gotten some people off the fence because obviously your payments, just by that rate reduction, I mean, your payments down about $350 depending on your loan amount. So it definitely has made a difference. But once again, I mean, I think it's still going to be a choppy market. I think the trend has been downward. We broke that trend, I think, in October. So I think the next 3 to 4, 5, 6 months, I think my take on it is that we're in this downtrend, but you're going to see little flare-ups, and if you're looking to buy a house, obviously, hopefully you can catch a good period of time in a 30, 40-day period where rates, are not flaring up. And that's where I think a good mortgage broker can give you some guidance as far as when to lock a rate versus calling some call center that just locks you for 30 days. Once again, I've said this maybe 10 million times, is that, to blindly lock a rate for 30 days is not giving the client the best, you're not putting them in the best advantageous spot because rates could have been rising for 3 weeks. You get that contract on the 30th day and rates are up here when you could say, okay, hey, we're going to wait a little bit, maybe wait a couple of days. And that's where, versus shopping for rates, shop for somebody that knows what's going on.
Yeah, when you're shopping for rates too, when you get that from the call center, and you know who we're talking about, and there's many of them. Look at the fees. Send that to Pat. Say, Pat, how does this
anybody?
look to you?
Yeah,
because send it to a mortgage broker. But Pat will take a look at it and go, well, it looks good, but did you know it's going to cost you $8,000 on the back end? To get that rate. So I can get you. And Pat may go, actually, this looks pretty decent, but if you just concentrate on the rate and you ignore the fees, you're really doing yourself a disservice. So push that as hard as I can. And here is number of price changes per week. These are price cuts. And you can see that we got down December. Of course, nobody lowered the price of their homes in December. Maybe, it says here, 682 people versus last year. Coming into the first of the year, we had 2,400 price cuts. I don't expect to see more price cuts until January. February. And we always had the new number of listings come out in January. And people are optimistic. And I saw one of our favorite Crash Bros do a video again talking about this house that was for sale for $800,000, and they finally had to reduce the price to $650,000. And I looked at the home. Well, that's what it comps at, $650,000. So, when you look at price cuts and you're looking on Zillow, take a look at what the home's really worth, because some people just come out aggressive because they have no idea what they're looking at. My house is worth $800,000. No, you're not even close to that.
Mm-hmm.
They got to roll it back $650,000. That doesn't mean the market is falling, folks. That just means that one house, I don't know what they were smoking. They tried to get $800,000 for it and they couldn't. So they finally came down to reality. And it's interesting. Oh, somebody's trying to sell me something here. Sorry for bothering you. Yes, I want to offer promotion on your channel. Viewers follow. This isn't the platform for that, but thank you. You can send me a private email, rick@rickhelps.com. So, but YouTube gets interesting, doesn't it? So I think we had that. Was it a couple of years ago we were on here? And we had another lender that kept coming up and popping up and trying to get business.
Yeah, somebody.
You remember that? He kept trying.
Yeah, it's like, hey, I could do it for this. So I'm like, all right.
Yeah, but he kept putting his contact information in the chat, and I sent him a private chat, and I said, stop spamming us here, pal. Get your own show.
No kidding.
It's pretty weird. You should see, Yeah, for those that don't know, YouTube has a section where I can check my comments, and then others called held for review. And held for review, I've got certain keywords in there that I just don't want to show up in a comment section, like anything to do with Bitcoin. Okay, if somebody said, because that ends up getting really spammy, and profanity. So you should see some of the comments that are in there that are held for review. So if you have sent a message and you put a comment in and it didn't show up, go back and read it. You might have, just, we all swear, but you might have put in some profanity, and YouTube's just not going to show it publicly. So that's my public service here. And Harold, I never buy retail. So, who was it? Some famous, was it Woody Allen said that? So, but, yeah, it's funny. You should see some of the comments that you're never going to see. They're held for review. And so I delete them. Like, wow, that guy was very angry when he typed that. So the YouTube world is funny. So if we go to next week, we've got the CPI coming out, just to recap on that for a second. And that's coming out on the 11th. If that ends up disappointing and being slightly higher, we could end up with a real knee-jerk reaction with the bond market, you think?
Yeah, we based on the last couple of weeks talking about a rate cut, yeah, we certainly could. I mean, I'm just in the camp that I think the Feds are just going to sit here. They're not going to raise rates, but they're just going to sit here. And I think they're at a content level right now. But like I said, if they lower them, then they're going to really put themselves in a corner. Do they raise them?
Well, if they sit here, they're marching. They're rolling a lot of stuff off their balance sheet too. So if they sit here, it's already doing its job. It's already slowed down housing. It's already caused job losses. So they could sit here and get where they want to go. It's whether or not they're going to have a hard landing or a soft landing. And Harold, so I'm in Hawaii yet, but when I get to Mesa Apache Junction, well, give us a call. We'll give you a hand. So I think they can sit here and they can write it out, but I'm no economist and I'm not going to guess. So I don't see any alarming numbers out there. I have credit concerns. I have debt concerns, but those debt concerns, Pat, they can mingle out there for a good 5 years.
Yeah. Yeah.
Do you know how old you would be if you were 1 trillion seconds old? Just to give you a concept of how much $1 trillion is.
They would be like, I'm just going to guess 150 years old.
You're close. You would actually be 32,000 years old.
Jesus. That's scary.
Let that sink in for a minute. You're 1 trillion seconds old. You'd be 32,000 years old. So
we're 34 trillion into it.
Yeah. Yeah. So Harold Duke says, I'm putting you to work for writing offers 15% under asking. I'll supply the ink. 15% under asking is probably not going to fly right now. And a lot of people are trying that. I mean, I had one come in on my condo today. It was 200,000 and the guy offered me 135.
But, like you said, yeah, I mean, you're kind of the camp, like, hey, throw it out there and start negotiating.
Yeah, I'll write it. I mean, no offer is a bad offer. At least it starts the conversation. If you're going to get 15% under asking, you're going to have to see a huge gap between the number of new listings and new contracts. Otherwise, they have no incentive to accept it. It's just math. And quite honestly, the other change too is you're writing 15% under asking. Keep in mind that if they wanted that as well, that they're already going to Open Door and submitting an offer that's probably offering them 10% under their asking price. So you have more competition in that arena. But it depends. Harold, it depends on what our inventory is like. And that's where, that's the reason I track this. If this gap that we see here between new listings and sales stays that big, which today's at 59%, then yeah, people are going to entertain selling 15% below. They're going to panic, but we'll see what happens.
I mean, you look at this, Mark, just to break off from that real quickly, different topic. But I mean, I just was thinking back in my mind as the train was going through my head, this last year and a half we were fighting the Fed going up. How many times, if you think about the whole thing, is kind of shifted. The trend has shifted. We went from, okay, how much are the Fed's going to raise rates? Now, like you said, October 19th, 20th, it was that break in the rate chart. I mean, on the charts, I think now you're like, now it's going to be the battle of like, okay, how are they going to cut? How far are they going to cut? So now we kind of shifted the whole dynamic. There's going to be probably volatility short term within periods. I mean, I think the downtrend is going to be down. I think we're past, that hot point in inflation. But now it's going to be the battle this whole year, I think, of, do they cut? Do they I mean, now it's going to be this battle on the other side.
Yeah.
You know what I mean?
Yeah. Because remember, we got close to 8 and people were coming out saying it's not going to be long. We're going to be at 9
or 10, 9 or 10. Yeah.
10. Here we go.
Now it's the battle of like, okay, now it's the battle on the other side of the wall, so to speak, as far as rates. Because like now they throw out, okay, we're going to sit tight here. They've sat tight for the last couple of meetings. Then you got all this chatter about 3 to 6 cuts. So now we've gone on the other side. So I think it's going to be an interesting battle within these short little periods of time of what rates. You're going to see little flare-ups, I think, in rates. Then they might settle down, So it's going to be, I still think, an interesting year. It's going to be a battle.
Well, both numbers are lower. So, listings are lower and sales are lower, but the listing success rate is still 97.3%. So 97.3% of home sellers are getting their asking price. That's a little above average. So there isn't a desperation out there. There just isn't a lot of activity. I also get comments, people going, I'm seeing a lot more for sale signs in my neighborhood lately. Well, you are, but that's because it's been so slow. And so remember, we were sitting here talking, we have 4,800 listings. So there were no for sale signs in your neighborhood. And it's probably normal for you to have like 4 at any given time, but there wasn't anything out there to sell. Realtors couldn't do open houses. Even if the for sale sign did go up and you saw the house, by the time you showed up on Friday to do the first open house, it was already under contract.
Yeah.
So a lot of what we're seeing now is us trying to get back to normal from these very, very low numbers on both sides, on listings and on transactions. And it's transactions that are down between 43 and 47%.
Yeah.
Because remember, we were looking at listings of only 4,800 and new contracts at a clip of 4,400 a week. Well, that doesn't take long to push those prices up. So that's where we're at now. I like seeing that we're no longer having that party out there, but and I don't see it coming back anytime soon. So that the fear monger, it's not fear mongering, it's some sales tactics by some agents saying, get out there now because that's going to come back. No, I don't think it is. And that's why I say, none of us have a crystal ball. Real estate agents definitely don't. The only thing that we have that you don't is I buy the data. I've got access to the Cromford report. I look at Axios. You can go to Redfin. Redfin's a good source. You can go to the buying tab and go down and look and get neighborhood reports, city reports, if you want to look at data. But we just have access to more numbers. Doesn't make us any better of a prognosticator. Well, Pat, I wish you'd have a great weekend. There's a good football game coming on Monday. My good old Washington State Huskies are playing Michigan, and I think they're playing in Houston. Was that probably about a 6:00 game, something like that?
Yeah, 6:30. Yep.
And that's the national championship.
I'm a Big Ten guy, so I'm gonna be rooting for Michigan.
They're both 14-0. So, okay, you're a Michigan guy. All right, pony up, buddy.
All right, we will. All right.
Okay. All right. Have a good weekend. See ya.
All right, buddy. See you, everybody.